Good morning, everyone, and welcome to another episode of the Market Snapshot series. My name is Rufus Kamau, Markets Analyst at FX Pesa. So today, we'll be talking about the key highlight events that will be expected to be moving the markets today, with a key focus on the job market, the ADP non-farm payrolls, yesterday's JOLTS job openings, and this Friday's non-farm payrolls. So as you all know, the assets of the week, the ones that have had the most volatility, is mainly gold, silver, US dollar pairs, as well as US equity indices. So we'll be doing technical analysis and try to understand the prevailing market patterns. As always, this session does not constitute any form of investment advice. It's not a recommendation to trade, so you should always do your own due diligence. So let's begin with the JOLTS job openings. This is the number of job advertisements in the US economy, and this is as reported yesterday. So from the JOLTS job report, I got a very interesting article from Axios, basically saying that there is new evidence that the job market is softening. So the job openings versus the number of unemployed Americans literally switched sides as per yesterday's data. And this was for the first time in 4 years. So the last time this happened was in 2021 during COVID, where the number of job openings were increasing as people are resuming back into the job market, and the number of unemployed Americans was moving further back downwards as people went back to their jobs after COVID. So now we've had this widened gap, and job openings have only been reducing since 2022, whereas the number of unemployed Americans has only been increasing. So as per the job report yesterday, the number of job openings was 7.18 million, whereas the number of unemployed Americans was 7.24 million, meaning that there is no enough jobs to cover for the number of unemployed Americans, and this is a red flag in the job market. So on the surface, the latest data on job openings, hirings, and firings points to a steady as she goes labor market. Beneath the surface, it shows a job market with widening cracks. Why it matters? Wednesday's release adds to the evidence that the labor market could use some help as the Federal Reserve weighs on an interest rate cut on the 17th of September. So revisions to June numbers pointed to much higher rates of firings and discharges than first reported, matching a pattern of negative revisions seen in job growth data. So in July, the number of unemployed people surpassed the number of job openings for the first time in 4 years. So what's driving the news? The number of job openings fell by 176,000 in July, and the rate ticked down to 44.3%, matching its lowest since mid-2020. So the height of post-pandemic job market boom, in the spring of 2022, there were more than 2 job openings for every unemployed person. So as of July, that ratio has fallen to 0.99. So this is yet another data point underscoring how this job market is frozen, and it's difficult for anyone to get a job right now, wrote Heather Long. This is chief economist at Navi Federal Credit Union in a note. So by the numbers, other key data points in the job openings and labor turnover survey were of the nothing to see here variety. The hiring rate was stable, and as were the rates at which people voluntarily quit their jobs and were discharged or laid off. So there are, however, sharp negative revisions to June numbers, particularly in layoffs and discharges. So the number of job openings in June was revised down by 80,000, and the number of people who lost their jobs involuntarily that month was revised up by a whopping 192,000 from the earlier estimate. So this basically shows that there is even more cracks in the US job market, and whenever there is cracks in the job market and the economy cannot sustain or create enough jobs for the unemployed, the Fed is mandated to stimulate the economy. And stimulating the economy means that first, the Fed needs to cut interest rates, and second, it needs to do what we call quantitative easing, or basically printing money to support economic growth. So in that case, we expect to see more pressure on the Fed to go for cuts, and whenever you see cuts, the overall reaction is that we expect to see a much weaker dollar, but then rate cuts are quite positive for the stock market. So we could be seeing a stronger rally in the SP 500, the Nasdaq, the Dow Jones, and the Russell 2000 indices. So outside of that, now moving into the economic calendar, you'll notice that there has been quite a number of data points as of this morning, with Switzerland's CPI showing 0.1% in the negative change. And in this case, it basically means that a basket of goods and services that are consumed by the average household in Switzerland are reduced in price over the prior month by 0.1%, which means that the economy might be heading into deflation. So that has the overall effect of strengthening the currency. So we should be watching out for the strength of the Swiss franc among peer currencies. So other than that, for the rest of the day, we'll be expecting quite a number of things. So one, I'll try to refresh to get the latest data point here. So construction PMI in the UK came in slightly higher, 45.5, compared to an expectation of 45.2, but still below the 50.0 midpoint, meaning that the industry of construction in the UK is still under contraction. So at midday, we'll be looking at the retail sales data. This is from the Eurozone. Then the ADP non-farm employment change, which will be the second job market data point to consider as we wait for the official non-farm payrolls on Friday. So we'll also be looking at the Challenger job cuts year over year, and of course the weekly unemployment claims at 3:30 p.m. So whenever we see signs of a weak labor market, that means more pressure on the Fed to cut rates. That likely means a much weaker dollar. So we'll be observing that with a key focus on the ADP non-farm payrolls. So as for the Challenger job cuts, as per the prior reading, there was a big spike of 139.8%. So this refers to the change in the number of job cuts announced by employers. So if you see more companies firing and the number increases, then this shows cracks in the job market. And as per the prior reading in July, it was an increase of 139.8%, which means that Trump is probably right by pushing the Fed to cut interest rates. So on the other hand, looking at the ADP non-farm payrolls, we had a reading of 73K as per the prior reading in the last month. And if you look at the actual data over the past 5 readings or so, you'd notice that we have been missing the projections. For 3 consecutive months, we were missing projections, with July 2025 showing a big contraction of negative 33K. So then July 30, it was higher than expected at 104K, but then now we're expecting a reduction to 73K. So if the number of new jobs created in the private sector in the US is reducing and we get a much lower number than 73K, then we'll be expecting a weaker dollar and of course stronger equities. But then if we happen to see a big uptick in employment data, then that would likely lead to a stronger dollar. So on the other hand, the weekly unemployment claims haven't had a lot of variance. So if you look at the last couple of readings, we have been moving around, I would say between 220 and 245. 245 being the highest that we saw in June 18, then 236, 233, 227, 221, 217, 218. Now it shows that there's some form of recovery forming up. So I would like us to look at the line chart, and in this case, you notice that yes, there was a period it was rising with a peak in June 12, but then from there, week by week, we have been seeing the numbers going down, an attempt to recovery, and now even further back downwards, meaning that the number of people claiming for unemployment insurance have been mostly sideways. And this can be identified as the average around 227 to 28 since the month of June. So clearly, if we have a wide variance with the outcome, in this case, a much bigger or smaller number compared to 230K, there will be a big market reaction. But then our main focus will be on the ADP non-farm payrolls. So on the services sector in the US economy, it's still in expansion territory, with the prior reading being 50.1, which was a slowdown from the prior 50.8. But then if you look at the history of this data, you'll notice that, yes, there was this period we were playing around 48, 49.4. And once the market jumped above 50, we have maintained there, though we have had periods of 54, 56, 54, 53, 50, 51, indicating some form of expansion in the services sector, except June when we had some contraction and we went below 50.0. Then July and August, there was a surprise uptick. So in this case, if we see a much better than expected data point, then that would likely boost the dollar. That is, if services sector is strong, the dollar is expected to strengthen. But then a weaker services sector would likely weaken the dollar. So on the other hand, we'll be looking at the IEA crude oil inventories. This will be at 7 p.m. We expect a draw of 2 million barrels, which would likely show scarcity in oil. And scarcity in oil means higher prices. On the other hand, if there's an increase in oil stocks, then that would likely mean lower prices. So as for natural gas, we expect a huge uptick from 18 billion to 54 billion barrels. And in this case, we expect an increase in stocks to likely lead to much lower prices. So other than that, looking at other key highlights in the market, an article from Rabobank explains what happened to the GBP, especially on Tuesday, when you saw a big sell-off, mainly because bond yields are running, with the 30-year bond yields in the UK hitting 5.67. So when this happened, there was a lot of fear that a lot of investors are dumping UK bonds, and as a result, we saw the pound weakening. So the UK is clearly not the only country facing a difficult fiscal prognosis. I'll try and zoom this so it's more readable. So the UK is clearly not the only country facing difficult fiscal prognosis, but since it also runs a sizable current account deficit, there is potential for the exchange rate to be primarily sensitive to bad fundamental news. This week, the pound has again demonstrated its reaction function to a jittery gilts market. So the gilts market is the market for UK bonds. So yesterday, cable plunged around 1.5% into its lows as the USD picked up a safe haven bid. Headed into what is expected to be a tough autumn budget by UK Chancellor Reeves on November 26, we expect GBP to remain on the back foot. We continue to expect Euro GBP to grind higher in the months ahead and see scope for cable to dip to 1.33 for pound USD on a 1 to 3 month view. So various sovereign bond markets are currently under pressure from differing combinations of concerns around inflation, government spending, and supply. Fears that the US Treasury may have to relinquish revenue from tariffs if they are deemed illegal has created a new wave of worry for treasuries. In Japan, another bout of speculation about the future of PM Ishiba has stirred concerns about a more populist leadership more inclined towards fiscal stimulus. In Europe, comparisons can be drawn between the fiscal positions of the UK and France. Currently, it is France that is facing more immediate crisis, given the potential for its government to collapse with the September 8 confidence vote called by PM Bayrou. France's National Assembly is divided into factions, with various left-wing parties opposed to welfare cuts, despite the country's large budget deficit and debt. So the UK government is more stable in view of Labour's strong parliamentary majority. However, the refusal of many Labour MPs to back the government's full welfare reform package this year is symptomatic of the fractures that exist within the party. So limited by the small appetite for spending cuts from its own MPs, it pledges not to raise taxes on workers, its own fiscal rules, and the limited appetite for the gilt market for more supply. The UK government has backed itself into a corner which has underpinned the importance of the UK's autumn budget. So other than that, looking at the other key highlights, bond sell-off eases. Clearly, we had seen a very strong rally in bond yields in the earlier trading days of the week, but today we are seeing the bond yields easing. So looking at a summary of bond yields, you'll notice that the US 10-year bond yields are down 0.02%, UK 0.01, Japan 0.03, Australia 0.03, and more focus on the EU or the Eurozone. You'll notice that German bond yields are down 0.02%, France down 0.02%, Switzerland 0.03%. Clearly, with bond yields reducing, then we should be seeing some of these currencies making some recoveries, including the pound, the euro, the Swiss franc, and so on. So now looking at Forex and trying to understand the performance of currencies as of this morning, you'd notice that here, the currency that was the biggest loser as of yesterday, which was the pound, now is the biggest gainer, meaning that it's making some good recovery, up 0.08% against the USD. So on the other hand, other currencies are slightly lower, losing to the dollar, including the euro, Swiss franc, Canadian dollar, yen, New Zealand dollar, and Australian dollar. And if you look at the week, that is on the week to date, then you'd notice something here. The Japanese yen has been the biggest loser, down 0.80%. The Canadian dollar 0.52, Swiss franc 0.49, pound 0.38%, New Zealand dollar 0.37%, euro 0.25%, Australian dollar 0.14%, with the US dollar being the strongest currency as per this week. However, now that bond yields are showing some form of stability today, we expect these currencies to be making recoveries against the USD. So also, as we proceed, kindly note that we have a new community on FX Pesa Twitter. Make sure to check it out. It's on the pinned tweet. It's called Chats and Chatter. So if you enjoy market updates on X, then make sure to check it out and join the community. And on top of that, we also have a Telegram community for the bullish banter. So if you'd like to join the Telegram community, I'll be sharing the link in the comment section. And once you get the link, make sure to join the Telegram community. I'll be sharing more market updates surrounding bullish banter topics. So this is mainly market content that will help you improve your game. So let's get into some technical analysis before we end the session. And of course, if you have any questions arising, feel free to type them in the comment section. So technical analysis. So as highlighted in the title of the session today, so we'll be looking at how to trade gold, how to trade silver, as well as US dollar pairs ahead of the ADP non-farm payrolls. So let's start with gold. So gold has been on a very strong rally. So if you look at the daily time frame, we had 1, 2, 3, 4, 5 months of basically sideways momentum. And sideways momentum is not a good grind for traders who enjoy a very strong bullish momentum. So for 5 months, more sideways momentum. And then as we entered the month of September and the last week of August, we've had a very strong bullish momentum in gold. And from here, I would say out of 11 trading sessions, only 2 have been bearish and not even that impactful. The rest have been green, 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 green. Save for today, we have had a pullback from yesterday's rally, but it seems like the market rejected lower prices and it's bouncing on strongly and looking to extend the yesterday's rally. So from the 15 minutes chart, you can see there was a very strong momentum downwards, and today during the Tokyo session, there was a sharp drop which was followed up by a very strong bounce. And now as we enter the London session, more likelihood that gold reclaims yesterday's territory and pushes towards the previous high. So yesterday was the highest price that the gold price of gold has ever traded at 35,000, and this is around 35,000 and sorry, $3,578 per ounce of gold. So it's a very strong bullish momentum. It would be a crime to bet against it, and in this case, that does not mean investment advice. So I'm just suggesting that there's a strong likelihood that this bullish momentum continues, even though this is the deepest pullback we have seen yet compared to the prior days. It's more likely that gold will continue to extend the bullish momentum. So the same thing has been happening to silver, which has been on a very strong bullish momentum, hitting a multi-year high of $41.4 per ounce. And after the pullback that we saw yesterday in the evening and today in the morning, we found some key level support, and since then silver prices have been pushing higher. So in this case, there's an expectation that silver will continue the bullish momentum, in this case aiming to extend the rally above $41.473 per ounce of silver. So there has been also increased momentum in oil. Brent oil prices reaching a high of 69.432. But then if you look at the daily time frame, between yesterday and today, we have erased some good momentum that we had experienced for the last 5 days. So 5 days of bullish momentum, moving from $66 to 69.4. Then yesterday, a big sell-off, and today the sell-off continues. So with the key level support at 66.407, that's the price action we will be observing. So in this case, an expectation that the market extends the bearish momentum here to the key level support of $66.4 per barrel. And once we get to this area, we'll be observing whether the market struggles to break, because if there is a break, then a potential extension could drop down to around 65. So yes, for now, the expectation is a sharp drop to 66.4. But then once we get to that area, there's no telling whether the market will extend the bearish momentum to 65.331 price level. So on the US dollar pairs, I'll be starting with the dollar index. Clearly, the dollar index had a bit of a strong momentum on Tuesday. But then on Wednesday, a sharp drop, and today the expectation is that some of these gains that we saw on Tuesday could continue being erased in the market, especially considering the job market report. So as we have seen, the trend in the job market seems to be weakening, and a weakening job market likely means there will be a weaker dollar. So in this regard, we should be looking at some of these currencies making some recoveries. So as for Euro USD, notice the big sell-off on Tuesday, Wednesday some good recovery, and today sideways momentum. So in this case, if you just eliminate everything from your chart and you just focus on today's price action, then you notice the likelihood of a strong break after the ADP non-farm payrolls or at the New York Open. So in this case, it basically prints a picture of a market that is consolidating, nothing much of a volatility, which means that any break, whether to the upside or to the downside, could mean a big impulsive move. So that is likely to play out today, especially during the New York session, with a main focus on the ADP non-farm payrolls. And of course, a weak dollar would likely mean that the euro begins the recovery journey. So we'll be observing this closely as the day progresses. You look at pound USD, it has made some good recovery, especially yesterday. And then today, we are seeing the same stuff. The path to recovery continues, with this being the consolidation we were watching. And in the last 1 hour, we have seen some very strong break towards the upside, which likely implies that the pound could be headed higher. And of course, the destination is back to the mean, where the market had started the bearish move on Tuesday. So as bond yields ease, then we should be looking at an extension of the bullish momentum. So AUD-USD also had quite some volatility. Tuesday sell-off, yesterday recovered, and today is moving further back downwards. And in this case, from a technical perspective, likely we are going to retest this area here around 0.65. So on dollar trading against the Swiss franc, we have a pretty strong resistance area here. So the market has been really struggling to break that area and failing each time. So if we happen to see a weak dollar this afternoon, then we should be seeing a bounce here and likely head to the swing low that we saw on Tuesday afternoon. And this is the around the price action level of 0.8. So on the USD trading against the JPY, from the 4-hour time frame, the market has been unable to break 149.14 price action level for a while. So only once we have had this bullish momentum, which was erased immediately, which likely implies that for this period, this market has been more of a sideways market. So now that we know it's a sideways market with upswings and downswings, we know that the most recent swing was an upswing, and now it's I would be confident to say we are on a downswing. So on this downswing from the 1-hour time frame, you can see there was a bit of a sell-off yesterday. So today we have attempted to go up, but the momentum doesn't seem all that sustained. So there's a likelihood that the momentum continues pushing lower in case we have a weaker dollar in the market. So on the equities side, the China A50 cash index has basically ended the bullish momentum in what looks like a double top formation, which means that the profit taking could be taking place and the market could pull back for a while. So we have already seen it happen in first half of last week and first half of this week. So good likelihood that we continue pushing lower. For the UK 100 index, here we are seeing a market that broke the upper trend line yesterday and today is attempting to push higher. So given that there was a big sell-off in bonds that resulted in the weakening of equities, now we are seeing the reverse and the market making some impressive recovery. So in this case, good likelihood that we see another push to around a prior high of 9,226. So on the Nikkei 225 index, also we had a big sell-off for the last 3 weeks. But now this week, we are seeing a push towards the upper side, and having broken the upper trend line, then there's a good chance that we could be seeing perhaps a retest and continuation, or even a straight up rally. So retests usually happen like this. Market breaks out of a trend line, pulls back, and then from there it happens to rally in the direction of the break. So on the US equity side, we are seeing there was a big weakness on Tuesday, then recovery in the evening. Wednesday we pushed higher, and today there seems to be some form of continuation. And as per our earlier target, which was going for 23,581, we are right back to the same expectation. So from the 4-hour time frame, we expect the market to push to 23,581 for the Nasdaq. So for the Dow Jones, it's more of a sideways momentum for the last 2 days. So you can literally put a box in the price action as per yesterday. But then after yesterday's price action, notice how volatility has really gone down, which is setting up for a potential strong momentum, especially after ADP and official non-farm payrolls tomorrow, with the likelihood of a strong recovery towards the prior high. And the prior high is around 45,763. So for the SP 500, also after some consolidation here, we had a big sell-off on Tuesday, good recovery, further recovery yesterday, and today we could be seeing the market extend to the height of the consolidation here, which was around the 64.80 price action level. So as for European equity indices, but before we do that, let's look at Bitcoin. So Bitcoin, as we had projected on Monday, very strong rally towards this area. So there was a pullback on Monday evening and Tuesday morning, but then the market kept the pace and eventually got to an 11,900. So today we have seen a bit of a sell-off in Bitcoin, indicating that we might be in the same sequence of price action, where anytime we have a rally, we have a much bigger drop, a rally, a much bigger drop, and then after this rally, we could be seeing a much bigger drop. So perhaps we're looking to get back to the 100K price action area, unless we have some form of support, something like a Fed rate cut, which would likely happen on September 17th. Today is September 4, so we are still not yet out of the woods. So for the German stock market index, big sell-off. So today is the one day we are seeing some form of recovery. So if I was to eliminate my prior patterns, I would notice that there was a big sell on Tuesday, more of a sideways momentum on Wednesday. And today, it seems like we are still stuck in this formation here. More like a bearish flag, and we are still trading within the flag. So I would be watching this area here for a potential reversal and the market stays within the pattern, or a break and we extend the recovery. So for EU50, an attempt this morning to break the lower trend line, which implies a possibility of the market extending the bearish sell-off that we have been seeing since last week. So clearly it's a very strong bearish market. So the potential of a break is shaping up for a potential short selling trade. So as for the France 40 stock market index, same thing, big sell-off last week. This week seems a bit mixed, but good chance that we see a continuation. I don't think this is a very strong support area. There is a chance that we extend to prior lows. And as you can see, if I remove everything here, you'd notice that the market has mainly been finding support around these areas and resistance around these areas in what looks like a sideways market. So this market seems to be just grinding sideways, and now we are on a swing where the market is headed towards support. So for the Swiss stock market index, surprise uptick on the daily, we are looking to reclaim level we had seen earlier, and this is a level that we saw here. This was on the 19th of May. So clearly the market is pushing for that area. So strong momentum as of this morning. Whereas as for the Norway stock market index, it's more of a sideways grind. Nothing much happening here. So even if we are attempting to push into new highs, I would say since the month of June, this market has simply been moving sideways. And now that we are switching from the upper side towards the lower side, a good likelihood that we see the market going for support. So that's it for today. Thank you very much, everyone. Make sure to check out the latest episode of the Bullish Banter podcast. I'll be sharing the screen. So in the latest episode, we get yet another guest from Uganda, from beginner to mentor. Make sure to check it out, where we dive deeper into the intricacies of leveling up your game from a beginner to breaking even to making profits and eventually mentoring other traders. So make sure to check it out, leave us a comment, and like and subscribe to the channel. So that's it for today. If you are a beginner, you're just starting your journey, make sure to register for a trading account. It's free of charge on the links below. And on top of that, if you enjoyed this particular session, remember to join every day, Monday to Friday at exactly 11 a.m. And on top of that, if you are just learning how to trade, make sure to visit FX Pesa on YouTube. Then click playlists. Then from the playlist section, scroll to the Novice to Pro course. Novice to Pro is a course that I did about 2 years ago. It will basically help you transition from a beginner trader, right from introduction to trading through to trading like a pro within 10 episodes. So that's it for today. Thank you very much, everyone. I'm checking the comment section to see if there's any questions before we end the session. Good morning, Maureen, NC West Official, Ibzan, Lina, Nicholas, Odiwa, Caleb. Thank you, guys. I appreciate this. Thanks, Rufus, for the FX book sentiments heads up. Thank you. You are most welcome. So every now and then I'll try to drop a hint on some more stuff that will help level up your trading game. So good question. How does cutting rates increase value of indices? So a low interest rate environment means that capital is cheap. It comes in ahead or in front of Fed printing more cash. So whenever you see a central bank cutting interest rates, in most cases, they are likely to be printing more cash. So when they print more cash, this cash that is increases in the economy, a good portion of it ends up in the stock market. So if loans are cheap and there's a lot of liquidity in the market, a lot of this cash will find itself in the stock market by investors. And of course, if it finds itself, a portion that finds itself in the citizens' pockets, means that the citizens get to buy more goods and services from the companies providing those goods. So in that case, it tends to be positive, and you can verify this by looking at the last time the Fed was cutting rates to zero, then that was during COVID. We saw the market recover in about 3 months, and that tends to be the trend. So that's it for the day. Thank you very much, everyone. Remember to share this episode with any of your followers or communities. And if they find it useful, then my goal will have been achieved. So that's all. Enjoy the rest of your trading day.